Hello and welcome to another financial analysis video with myself, Moeed Amin, and Ted Wayman. The goal for this show is to help you build your business acumen by helping you read and analyze financial statements. So if you want to get better at business, then you better understand the language of business, and that is finance. And that is what we're here to help you do. So whether you're in sales, whether you are a budding investor, whether you are anyone involved in the business world, if you want to grow in your career and in your competencies, then you've really got to understand the finances behind the companies that you are working for and the companies that you work with, whether they're clients, partners, etc., or suppliers. So, and we help you do that by analyzing the financial statements of well-known companies, most of which are going to be public companies. So today we're actually analyzing one of those businesses. So a company called Victoria Carpets. So they're a company that was founded in 1895, right, in Scotland, and essentially they do what they call as innovative flooring solutions, essentially carpet services, maintenance, things like that as well. So we're not going to go into too much detail about that. We don't claim to be knowledgeable about the industry. What we are good at is analyzing the financial statements and giving you the tools and methods by which you can analyze them yourself and any future financial statements as well. Quick note on the share price, and stick around, by the way, because we're going to look into the share price in a bit more detail once we've analyzed the financial statements, kind of look at those two things together to see if there's any inference we can draw from that. So it's important. So they floated in 1997. If you'd invested back then, you'd be sitting on a nice tidy profit or tidy increase of just over 2,300%. If you'd invested 5 years ago, you'd be sitting on a loss of 39%. And if you invested a year ago, you'd be sitting on an even greater loss of just over 60%. So they've obviously gone through some form of pain in the last year. And we'll talk about that in more detail. This particular company, was a request from one of our viewers. And in fact, 98% of the videos, 98% of the companies that we analyze are requests from our viewers. And I'll tell you in a moment how you can make your own requests. So Alex, here is your video. I hope you find it useful. And he also put some context in there, which is very, very important. And we like that context. So if you want us to analyze a company for you, you're interested in that company, all you need to do is leave a note in the comment section. Obviously, give the name of the company you're interested in, but also give some context, as Alex has done, as to why you're interested in that company. The more interesting the background information or context or reason, the higher likelihood you're going to be pushed up the priority ladder, right? So we're going to look into Alex's interested company now, and we're going to particularly look at the cash flow statement as well, because he's mentioned that in his request. So Ted, please take it over. Let's share with Alex and the rest of our viewers some information we found about this company.
Absolutely. So good to see you, Moeed, again, and good to see all of our subscribers. Welcome back to our subscribers. If you are not a subscriber, then welcome, and please do become a subscriber. So just click on the subscribe button, which is, I think, down below or somewhere. I don't know where. You know where the subscribe button is. So click on the subscribe button. Don't forget to like, share as well this video. So here we go. We're looking at Victoria Carpets. This is their annual report and account. It's available on their website. It's actually down as Victoria PLC, not Victoria Carpets. So I think Victoria PLC owns Victoria Carpets and other businesses as well. So this is very much a Victoria PLC. Lots of information here. We're going to come back to this because there are some interesting points in the audit report, but we're going to bounce all the way through, first of all, to the income statement. So here is our income statement. So these guys are quite interesting. So we're looking at, this is 52 weeks ended April 2022. Sales £1 billion. So we're in millions of pounds. If you notice, 1,000 million, that's £1 billion. The cost of sales, so if you bought a carpet from them, the cost of sales is £663 million, which is about 65%. That means for every £1 you spend on a carpet, these guys spend 65p buying that carpet and make a profit of 35p. However, they have a lot of overheads. So what they have is a lot of distribution costs and admin expenses, 200 million in admin expenses, which results in an operating profit of a mere 53 million pounds. Okay, so 53 million pounds. So, very, very, high turnover, but, really not a big profit margin. That's about a 5% profit margin. And then if we scroll down a little bit further, you'll notice that these guys have financing costs of 66 million pounds. Now, if you're making a profit of 53 million pounds and your interest is 66 million pounds, you basically are giving away all of your profit to the bank, and it means that the shareholders are basically left with nothing. So the shareholders, there's a loss for the company overall of 12 million, very similar to the previous year. They effectively broken even. They just made no money, didn't lose much money, but they didn't make any money. And the same with this year. It's just they're giving away all of their profit. So this is an issue, and especially today. So this could be described as a zombie company. It's got too much debt on there, and in effect, what they're trying to do, what they're, the risks that these guys face is that as we see interest rates increase, which they are at the moment, then their financing costs are going to go up, and these guys are going to continue to struggle and struggle. So there's the profit. Are they booking fictitious profits? I'm not sure whether they're booking fictitious profits. I'm always a bit nervous about this non-underlying item. You'll notice that non-underlying items happen on a fairly kind of regular basis. So I just tend to ignore all of that kind of like, we've got sort of non-recurring administrative expenses that seem to recur every single year, for example. So I tend to kind of just ignore that. So don't get distracted by kind of like the sort of talking about core profitability. Always focus, I think, on the on this number here. So we want the total number. That's the important one. Let's look at their balance sheet and see how the balance sheet, what the balance sheet is looking like. So these guys got quite a lot of goodwill, suggests that they've been growing through acquisition. They've got quite a lot of intangible assets, interestingly enough. So, you might think about that as kind of, intellectual property rights, perhaps, maybe it's kind of development. So a little bit nervous about that carpet company with kind of, intangible assets, software, not sure about that. And then they've got property, plant and equipment, as we'd expect. So, they say they've got 890 million pounds worth of assets, but I wouldn't expect you can put that on eBay and realize that. They do have a reasonable amount of cash. They've got inventories, as you'd expect. Inventories have grown because the company's been growing. Remember, look at the revenue. Just go back to our revenue. So the revenue, big increase in revenue. So these guys, have been growing. They've been growing through, organically, I guess, as well as acquisition. Don't forget, the year ended April 2021 will be kind of end of COVID. So they'd have been struggling through the lockdown as well. Current liabilities, suppliers, pretty straightforward. So the liquidity ratio really doesn't look any problems at all. Current assets compared to the current liabilities. And even if you eliminate the inventory and do your acid test, as we call it, because the inventory is the least liquid of your liquid stock, even then they've got enough trade receivables and they've got enough cash to be able to pay their suppliers. So liquidity doesn't look a big problem. In terms of the rest of the balance sheet, what jumps out at us is this number here. So they've got some other non-current financial liabilities, and they also have what's called this preferred equity. Now, this is quite an interesting one, a kind of a bit of a question mark. We might want to go and have a look at that. This is all detailed in note 16 as to what is actually going on there. So, they do have quite a lot of debt, and we know they've got a lot of debt because they've got a lot of interest that they're paying. But this preferred equity, and suddenly preferred equity, contractually linked warrants, etc., that to me, that's a bit of an alarm bell, and I'd like to go know a little bit more about that. So if we want to know more about that, we need to go and have a look at note number 16. So a quick scroll down through the notes into the detail, and we find, here we go, here's note number 16, other financial liabilities. Little bit of bank overdrafts, that's absolutely fine. And then we get to the debt. So here's the sort of the debt. and the senior debt and junior debt, and that's absolutely fine as well. So they're going to structure their debt in terms of, you know, senior debt gets paid first if there's a problem, junior debt gets paid a little bit later on, some unsecured loans, and then you get into this preferred equity. And I have to admit, I started to read through this and I thought, actually, I really can't be bothered to read through this. You know, there's lots of A shares and B shares, and you've got kind of this preferred dividend of 8.3%, which basically means it's kind of like they have to pay the dividend to the preferred equity before they pay to the normal shareholders, if that makes sense. And it also builds up. So if they missed the payment last year because they don't have enough money, and they don't, then it kind of rolls over until it can be paid. So, you know, you kind of look at these guys and think, well, I wonder who these guys are, this Koch Equity Development and the kind of KD Victoria Investments LLC. And I kind of wonder about the directors' potential involvement in that. Now, I don't know whether the directors are involved or not, but if they have any involvement at all, that would immediately start to signal a lot of alarm bells for me. So quite interesting that these guys, they wanted to classify it as equity, but IFRS says that you can't classify it as equity, you have to put it into the liability. But you'll see here things like, you know, if the group becomes insolvent, being bankrupt, placing into receivership, then, you know, effectively, you know, what happens is that, you know, these guys start to take ownership of the business. So if you're a shareholder of these businesses, you are sitting well behind these guys. These guys will take, if the company starts to choke, they will take control of the business, and effectively you as a normal shareholder will get effectively nothing. So if you are looking at investing in this, I would read this note with a lot of detail. Okay, so here's my accounting recognition. As I said, it's under IFRS, it's a financial liability, although they say it is legally structured as an equity instrument, and therefore should, the argument is, be sitting in the equity side, but actually they've actually put it in the debt side. And again, that's probably just to say that, you know, you as a shareholder, you know, these guys aren't going to get paid before you do. So if the company goes, your shares are very likely to go to zero. So there's our first kind of alarm bell, and our kind of first you know, little bit of sort of nervousness, I guess. We go back to our accounts. We can look at the just finish off on our balance sheet. So here's the equity, so reasonable amount of equity in there. Again, you know, the argument is that these guys want to reclassify that as equity, but they're not allowed to. Retained earnings. Now, retained earnings, quite interesting here. So retained earnings, couldn't quite work out what's going on here. So, you know, they've made a loss and their retained earnings has gone down, as you'd expect. However, there's a little bit of shenanigans going on here, because if you look in the movement in equity, so this share premium, this is last year, the share premium, that's the extra amount invested by the shareholders into the business. So this is kind of the nominal value of the shares, and then this is kind of any premium over and above the original investment. And what's happened here is that last year they then reclassified that, and basically, for quite how they did it, I don't know, but they basically reclassified it as a retained earnings. So rather than, you know, they've cancelled the share premium account and basically put it in as profits. And that's probably when you're talking about fictitious profits. So there's no fictitious profit, or, you know, it doesn't look like there's fictitious profits in the profit and loss account, but it certainly looks like there's fictitious profits in the retained earnings in the equity. So this is, you know, making it up as you go along. And quite frankly, how they can get away with that, I'm not absolutely certain, but obviously they're allowed to, because the auditors have signed it off. So yeah, big highlight there. These guys, you know, they look like they're sitting on retained profits. They're not. They are making losses. And without this number here, this 290, they'd be sitting on 100 million of retained loss. And if they hadn't had that investment, then effectively they'd have a negative balance sheet. In this year, this particular year, nothing very interesting going on. They're booking a loss, no dividends, no share buybacks. Was it a share buyback the previous year? Interesting enough. Again, you know, it looks a sort of slightly bizarre thing to happen there. So movement in equity, obviously very important statement there, and sort of finding out what's going on and quite, you know, how they're up to it, I have no idea. Anyway, let's come on to the cash flow statement. Cash flow statement, the cash inflow from operating activities they are generating cash. There we go. And again, so generating cash, which is good. There's the operating profit. They start with the operating profit. The biggest movement is obviously we add back depreciation and amortization. This is a non-cash expense. So if you remember, depreciation and amortization being depreciation of intangible assets, they're amortizing. You notice IT software. So a lot of those intangibles will be IT software. You know, obviously developing their own software. I'm not sure why they necessarily need to develop their own software, but obviously they've got a good reason for it. So depreciation, amortization, and this is effectively a non-cash expense, and that's really why they are, generating cash. This section here is pretty important as well. This is the movement in their working capital, which is really they're increasing their inventory, increasing their trade receivables, and also increasing the amount that they owe to their suppliers. I don't think there's a major issue there. They are growing. We can see them growing. And so, if you're increasing the amount of money you owe to your suppliers, it suggests you're not paying your suppliers. And if you're not paying your suppliers will stop supplying you. And these guys, if they don't have any carpets to sell, they won't be they'll be out of business pretty quickly. But I don't think that that's a major issue there. So we're really coming down to this net operating cash flow of about 60 million last year, 70 million this year, and that looks absolutely fine. Purchase of property, plant and equipment. So here's their capex. Interesting enough, in this year there was an acquisition of subsidiary that's going to give rise to more goodwill. They're using up cash, and then they're also investing in the business. Although you'll notice that the capex, the purchase of property, plant and equipment, is very similar to their depreciation, and so they're it suggests that they're maintaining their business. So they're not really investing in their existing business, they're growing through acquisition. At least that's what it appears like. In terms of the financing activities, quite interesting going on here. So what we've got is repayment of borrowings, and then the issue of this preferred equity. So this is basically a debt for equity swap. What they've done is they said, we've raised this equity, we've used the money to repay the debt, we recognize we've got too much debt, we're trying to pay it down. That preferred equity is classified as debt. Even if it wasn't, you as if you are an ordinary shareholder in this company, you would be sitting behind this preferred equity. So it just looks to me like, I don't know, it just looks to me like there's a kind of a protection going on. So whoever this Kosh, I think it was, investment development fund, whoever they are, it just looks to me like they're trying to ring fence it, and if the company does wobble and go, then these guys are going to catch it and run with it, and ordinary shareholders will be wiped out. And that's just my gut feel. So I'm a little bit nervous about that. Anyway, they're generating 30 million in financing activities, and that's why their cash, so if you take the cash from investing, so if we just add these numbers up, if you take, if you're generating 70 million, investing 190 million, generating another 30 million, then you're going to be down by about 90 million on the year. And that's why their cash has gone down by 90 million. Now, while we had, I just, there's nothing nothing major going on in that cash flow. There's no real kind of alarm bells. They are generating cash. But I was just looking at the previous year, Moeed, and I don't know if you've got your calculator to hand, and you can add up these numbers for me. So if you've got your calculator, while I'm talking, you can see if you can take negative 64, add back 65, so you're basically on about negative 100, and then take off 30 and 11, which gets you to about negative 140, 141, and see if you can work out how you end up at a positive 163. So these are audited numbers and they don't add up, and I have no idea what's going on there. And so as soon as I see a set of numbers which don't actually add up, especially if they've been signed off by the auditors, I'm like, how can you, and maybe I'm missing something, maybe my maths isn't working here, but as far as I'm concerned, those numbers don't add up. You cannot repay, you cannot use 165 million to repay a borrowing, raise 65 million by issuing equity, buy back 30 million of shares, and do this payment of whatever it is, right underuse lease of 11 million, and end up with an extra 163 million quid in your balance sheet.
Yeah, I
Maybe
mean, I've done the calculation. I've come to a negative 140.
Yeah, exactly. Negative 140, exactly. So, you know, but you need it a positive. So, so these numbers all add up, but these numbers don't. So there's a big question mark here. So as soon as I'm seeing that, I'm thinking, you know what, if the numbers don't add up, then that's a problem. If the auditors haven't picked it up, that's another problem. And I'm starting to lose, lose a lot of sort of confidence in these guys. I did want to, I got a little bit nervous about that interest payable, and I wanted to go and have a look at the independent auditors report, and it's quite a long independent auditors report, and I was digging around to find out about kind of going concern. Little statement on director responsibilities, just so we're clear. It's the directors who prepare the accounts, not the auditors. The auditors check them. I'm not sure how closely these auditors have checked the numbers in the cash flow statement, but if you are the auditor of Victoria PLC, and that is Grant Thornton, so if you work for Grant Thornton, you might just want to go back and just double check whether, maybe it's my maths, maybe my calculator and Moeed's calculator doesn't work, but I'm suggesting that, those numbers don't add up. So there was a little statement here about going concern, and it's pretty standard stuff here. So, there's nothing kind of, like, oh, you need to go and have a look at this. But as I was going through this, and they talk about materiality, I thought this was a really interesting chart. I hadn't seen this before. So this is this chart, and I'm going to finish on this bit. So this is kind of looking at the risk in terms of the impact on the financial statements and the risk in terms of management judgment. So what it's saying here, top left, says that really there's no risk. We're quite comfortable we're a going concern, but if we weren't a going concern, it would have a big impact on the financial statements. And then they've got some stuff down here that says, actually, we're not sure about it, but it's not really going to affect the financial statements. But this is really important up here. So this says that, this is high risk. And if we get it wrong, it's going to have a big impact on the financial statements. Now, what have we got here? Very quickly, valuation. So the valuation of goodwill, they're saying, we're really not sure how to value goodwill. It's really, really complicated. These guys have got things going on all over the place, and we're really not sure whether the goodwill still exists. And if the goodwill doesn't exist, we'd have to write it down, and that would have a big impact on the financial statement. So that's one big question mark. Second one, completeness and accuracy of volume-based rebate arrangement with customers. Okay, now these guys, I guess, are wholesalers, and therefore they have a kind of, if you buy X number of carpets from us, we'll give you a discount, we'll give you a rebate. And the fact that there's questions by the auditor, they're saying, we think it's okay, but we're just, you know what, you just need to be careful of this. Recognition, measurement, and presentation of modified in the period complex preferred equity financial transactions. Well, we've highlighted that already, and the auditors are just saying these are really, really complex, and we just don't quite understand or get our head around them. And if it's really, really complex, why is a carpet company producing these really complex equity financial transactions? Just simplify it, just make it easy. Usually, to me, if there's a lot of complexity, there's stuff to hide, and so that's kind of more alarm bells to me. And then we've got accounting for significant business combinations, again, consolidation. So this is to me, this is a big red flag, and this just says to me, this is a very, very high risk company, I should say the accounts are very high risk. There's a very significant risk that the accounts are misstated. So what does all that mean in terms of the share price? Well, I'm not absolutely certain. They're not making a profit, so there's no PE ratio. They're not paying a dividend, so there's no dividend yield. They have a market cap of 463 million pounds compared to a balance sheet of about 203 million pounds, although they would argue that their balance sheet is bigger than that because the preferred equity they want to call, in which case they'd be trading at about book value. But again, this I think is this is the ordinary shareholder's valuation of the business, and if you're an ordinary shareholder, you're quite a long way back in the queue, and it's just the structure of that preferred equity investment and the complexity around it. Why would they structure it? Why would they create something with so much complexity in it? I just feel that if I was a shareholder, I would feel it wasn't really my company. Anyway, you can see, you know, recently these guys, you know, they've taken a big dive. Maybe there's other people that are feeling the same way. Maybe you're sitting there thinking, oh, well, Ted, look at the growth potential of this company. You know, it's going to bounce back. It's going to carry on going up, and you know, the sky's the limit. And here we are. We're going to, this time next year, Rodney, we're going to be millionaires. Don't forget, if you, whatever you spend on a share, the share can always go down to zero in terms of its valuation. So however cheap a company gets, you can always potentially lose absolutely everything. So is it a buy? It's not sitting in my portfolio, I have to admit, Moeed. Is it a short? So, you know, some people talk about these companies and say short. Well, shorting is not for the faint-hearted, because your downside is, you know, your downside is unlimited. Your upside is limited because it can only go to zero. So you can only gain your kind of, unless you're using leverage and derivative products, in which case caveat emptor or caveat investor in this case. So, you know, but you know, I think these guys, I kind of get a feeling like they're going to struggle. I think, you know, cost of living crisis, inflation, interest rates going up. There's a lot of headwinds in there, and it's really that preferred equity. That's the bit that just doesn't do it for me. Oh, and just make sure the numbers add up. It's not that difficult.
Yeah. Well, either way, I mean, even setting aside the investment element of this request and the analysis that we put in there, you know, nonetheless, from a educational point of view, if you're trying to improve your business acumen or financial acumen, this was a very interesting company to look at and a lot to learn from analyzing the finances of this business. So hopefully you found this all very useful. Certainly a very interesting company to look at from a financial perspective, and the financial statement and the fact that some of these things didn't add up, and the preferred equity. You know, I think most people will learn a lot from just this one video and from this one company. So we'd love to hear your thoughts. Do share your comments in the comment boxes below. Like, share, and subscribe. And if you have a company that you're interested in and you would like us to analyze their finances, do leave a note in the comment section with some story behind why you're interested in this company. So until the next video, thank you, everyone. Thank you, Ted.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share, and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos or sorry, any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share, and subscribe to the channel, and I will see you on the next video.